Hello, everyone, and welcome to this explainer. Look, if you're a chartered accountant, a tax professional, or a CA student, you already know the drill. The massive transition from the Legacy Income Tax Act of 1961 to the brand new Income Tax Act of 2025 is bringing some absolutely huge structural changes. And today, we're diving straight into a highly critical area of this new legislation, Chapter 13-F, which governs the special provisions relating to pass-through entities. But first, let's set the stage with a very practical situation. Imagine you have thousands of investors all pooling their hard-earned money into a massive real estate or infrastructure project. Now, the entity managing this pool is obviously going to earn a substantial income, right? Well, if that entity is taxed on the income, and then the investors get taxed all over again when that income is finally distributed to them, those returns would be absolutely crippled by double taxation. So how exactly do pooled investment vehicles avoid this heavy burden? Well, the answer lies right in the legislative framework we're unpacking today. Here's our roadmap. Today's agenda covers an introduction to pass-through entities, a detailed entity-wise explanation, a practical taxation example, compliance and filing requirements, common practical tax issues, and we'll wrap it all up with a summary and key takeaways. Let's jump right into Section 1, Intro to Pass-Through Entities. Okay, so the absolute heart of this framework is something called pass-through status. In simple, everyday terms, this is a statutory mechanism that literally shifts the tax liability away from the intermediate entity, like the trust or the fund, and passes it directly down to the ultimate unit holder. But here is the crucial takeaway. The income perfectly retains its original character. If the fund earned dividend income, the investor reports it as dividend income. If it was a capital gain, it stays a capital gain for the investor. It's taxed exactly as if the investor had just bypassed the fund entirely and made the direct investment themselves. This brilliantly eliminates the friction of entity-level double taxation.
Moving on to Section 2, Detailed Entity-Wise Explanation.
Now, for those of you who've spent years, maybe decades, living inside the Legacy Income Tax Act of 1961, we need to update your mental map. Under the old regime, we always looked at the 115 series. Venture capital funds were sitting under Section 115U, while now they fall neatly under Section 222 of the 2025 Act. Business trusts, which include your REITs and InVETs previously under 115UA, are now governed by Section 223, and finally, investment funds, formerly under 115UB, have been moved over to Section 224. Basically, Chapter 13F seamlessly consolidates all these provisions to maintain the original tax policy, but does it with much cleaner, updated statutory language. Next up, Section 3, a practical taxation example. Legal theory is great, but let's ground this in reality to see exactly how the cash and the tax flow actually work. Let's walk through this step by step using a real estate investment trust, or a REIT, under the new Section 223. Step 1. The business trust earns rental income from its commercial properties, or maybe interest income from its special purpose vehicles. Step 2. Under SEBI regulations, the trust is strictly mandated to distribute a minimum of 90% of this income straight to its unit holders. Now, Step 3 is where the magic of the pass-through provision really shines. Because of Section 223, this distributed income completely bypasses entity-level taxation. Zero tax at the trust level. Instead, it flows directly into the hands of the unit holder, retaining its exact classification as rental or interest income, and gets taxed at the unit holder's applicable slab rates. Beautifully simple, right? All right, let's look at Section 4, Compliance and Filing Requirements. Of course, we all know that with great tax benefits comes great compliance responsibility. Under Rule 145 of the Income Tax Rules 2026, compliance is actually split into two distinct tracks. First, we've got the filings made directly to the Income Tax Department. So that's Form 74 for VC funds, Form 76 for business trusts, and Form 79 for investment funds. The absolutely strict deadline here is the 15th of June following the end of the tax year. Mark your calendars. Second, we have the statements issued directly to the unit holders, things like Form 75 and Form 77. The entity must provide these statements to the investors so they have the exact, detailed breakdown of income they need to file their own individual tax returns. And it's not just about filling out forms. There is a serious level of precaution required here. Let's be honest, we all know how much the department loves their documentation. Entities must maintain rigorous, meticulous records classifying every single rupee of income, whether it's interest, rental, or dividend, alongside highly detailed, unit holder-wise distribution logs. Furthermore, the accuracy of forms like Form 76 isn't just a simple self-declaration. It requires mandatory verification and certification by a qualified chartered accountant, specifically as defined under Section 5153B of the new 2025 Act. along with a formal declaration by the authorized trustee. Let's shift gears to Section 5, Common Practical Tax Issues. Ask any seasoned tax professional and they'll tell you, the theory is neat, but the practice is messy. Here are the frequent errors that we see triggering notices all the time. First, misclassifying the very nature of the distributed income at the entity level. If a trust accidentally mislabels capital gains as other income, it messes up the tax rate for literally thousands of unit holders. Second, zooming in on the investor level, taxpayers frequently fail to report this income under the specific Schedule PTI, which stands for Pass-Through Income, in their ITR forms. Please advise your clients carefully on this one. Third, completely missing that strict June 15th deadline for department forms like Form 76. And finally, a major transition headache, professionals getting tripped up by the new terminology. Remember, the ITA 2025 has entirely scrapped those old, confusing assessment year and previous year concepts. We now solely use the term tax year, which aligns directly with the financial year. Finally, Section 6, Summary and Key Takeaways. We've covered a lot of ground today, so let's quickly consolidate what we've learned. First, Chapter XVI, covering Sections 221 through 224 of the new Income Tax Act 2025, is your ultimate statutory shield against double taxation for pooled vehicles. Second, make sure to update those mental maps. The old 115 series is out, Sections 222, 223, and 224 are in. Third, get comfortable with Rule 145 of the Income Tax Rules 2026, which clearly splits your departmental forms from your investor statements. Fourth, never, ever forget the golden rule of pass-throughs. The income always retains its original character for the end investor. And lastly, these complex filings absolutely require the statutory verification of a qualified chartered accountant. So as we all adapt to the ITA 2025 era, the big question isn't just about how to file these forms correctly. The real question is, how can you and your clients strategically restructure your upcoming pooled investments to completely maximize these exact pass-through benefits? Thank you for watching. Please like, subscribe, and share. Disclaimer: this video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.